Hi, my name's Joe Achaturo. I'm a certified public accountant, and I'm going to teach you everything you need to know about doing your own taxes. So let's get started. Okay, let's talk about the Qualified Business Income Deduction. This is a brand new deduction. It's actually an adjustment passed by Donald Trump and the Republicans for the tax year 2018. This is the single best growth policy passed by Donald Trump and the Republicans because it targets the number one growth engine of the U.S. economy, small businesses. Right? It targets companies being punished the most because they don't have ways around the tax code like a large corporation does. Right? It's not for rich people. It's not for mega companies. It's really for the small and medium-sized business that's growing. And it's for the type of businesses that are going to be hiring people more than relying on an individual's skill set. So let's take a look at it. This is going to be the short version. There's going to be another video that's a long version. The short version is going to cover 99% of you. If you fall under the thresholds on the next page, then you don't have to worry about anything. You get the full 20% deduction. If your income goes above the next page's thresholds, then there's all sorts of limitations, and you should really watch the longer video or have a CPA do your tax return. So let's take a look. What's the qualified business income deduction? It's a deduction in the amounts or adjustments worth up to 20% of the net income from a trade or business. All right? It's actually an adjustment. Adjustments can go, they can be additions or subtractions to your taxes. This is going to be a subtraction. And so the adjustments go on Schedule 1 and then flow through to your 1040. What's the actual calculation? It is a deduction equal to the lesser of 20% of taxable income computed before the deduction minus net capital gains. What are net capital gains? They are your capital gains subtracted by your capital losses. Then if you still have capital gains left over for that tax year, you have a capital gain. So for this example I'm going to do, just to show you how it works, this individual has $5,000 worth of capital gains, $100,000 worth of net income. So let's take a look. And the net income is completely from their business. None of it is from a W-2 wage. So let's look. $100,000 in net income. I've highlighted it in green so you can track the numbers easy. I'll subtract $5,000 of capital gains, gives you $95,000. Right? That's the formula. You take that $95,000 over here, follow the purple. You're going to multiply that by 20%, and that's your deduction. Your $15,000 is your adjustment. So what you're going to do is you're going to essentially take your entire income and subtract your $15,000 off of it. Right, so why do we subtract out the capital gains? Because the capital gains are different. They're taxed differently than ordinary gains. Right? Ordinary gains are going to be added to your income. Capital gains get taxed at a special tax rate. So instead of doubling up on the deduction, so you get a special tax rate because of your capital gains. On top of that, they're going to subtract that out because you're already getting some sort of benefit from that capital gain treatment. It's also important because a lot of wealthy people are going to have huge capital gains. Not 5,000, like 100,000, 100,000, and they don't want to give this this deduction to wealthy people, right? He limited it to people who aren't wealthy, making all their money off of investments. I see a lot of Facebook posts. I see lots of news media outlets claiming that this tax code and tax reform is for the wealthy. But I can point out lots of different things where he actually punished wealthy people. And this is one of them. Next. Self-employment is still going to be calculated based on your $100,000 of your business income. It's still going to be calculated on the full $100,000. This 20% deduction is going to just be a separate line item that allows you to calculate less income tax, not self-employment tax. Self-employment tax is different than income taxes. You also get the 20% deduction on a qualified real estate investment trust dividend, which is basically going to be REITs, and qualified publicly traded partnership income. In addition, here are the qualifications. Your company needs to be a U.S. trade or business, and it can't be a corporation. Now, some of you say, but I have a corporation and I'm an S Corp. That is an exception. But if you're taxed as a C Corp, you do not get this 20%. If you're taxed as an S Corp, you do. All right, you also get it if you're a sole any pass-through entity, right? That means the income is taxed on your personal tax return and not on a separate form 1120, right? So this is going to be your income is taxed on your personal tax return only. Sole proprietorship, partnership, LLC, LLP, limited partnerships, trusts, and estates. There's going to be income thresholds. This is going to be based on your income tax return amounts, and they're going to be based on your filing status. It's also going to be based on the type of business. Are you a service? Are you a non-service? Are you a specified service trader business? These are going to be all of this has to do with additional rules once you go above and beyond the income levels that I'm going to talk about on the next page. Real estate investment trust dividends, publicly traded partnerships. Those all qualify. So here's the rules for 99% of you. 99% of you are not going to worry about any limits to this deduction whatsoever. Single, head of household, married, filing single. Your limits are going to be 157 on your 5 on your income tax return. So if all the income on your income tax return is under 157,500, you get the full 20% deduction, no limitations. Married, filing joint, and farmers, your limit is essentially doubled, right? 315,000, you get the full 20%. Estates, 157,000. If your children are subject to the kiddie tax, as long as that income's less than 157,000, you get the 20% deduction. Non-grantor, completed and incompleted gift trusts, you get the full 20% if the income's less than 157,500. Once you get above these limits, right, and your filing status is this or this, we have to start phasing out the 20% deduction. And then once you get to a higher threshold, the deduction completely goes away. So again, your income's below this, which is going to be 99% of you, you get the full 20% and don't worry about the next video. If it's above, you need to watch the next video to understand the rules, because there's going to be all sorts of limitations. And that's going to be it. Don't forget to share this video with friends, family, or anyone you think might find some use out of it. Also, don't forget to subscribe to the YouTube channel. Go to myfreecpa.com and join there so you can keep track of your classes year after year after year. You can get updates when I make changes to them. And please, don't forget to click on the banner ads on myfreecpa.com or on any of these videos so we can get credit and keep these videos coming to you for free. Thank you, and have a great day. Thank you once again for watching this video. Don't forget to subscribe. Don't forget to click notifications. On My Free CPA on YouTube, you're going to have a link to myfreecpa.com. On here, I would encourage you to sign up, get yourself an account, because you're going to be able to save all the courses I put that are relevant to you. And you're going to be able to go back and reference them year after year after year. In addition, there's going to be a Do Your Own Taxes link. This is going to be free online tax software if your income is below a certain threshold. It's basically just like TurboTax or H&R Block online taxes, but cheaper, right? This is the professional software I use, put online for individuals. I'm going to be using this software in most of my videos to explain to you how to do your own taxes. So if you want to sign up for this, please use that link. And when you use that link, I get credit, right? If you're going to do a tax return that's going to cost you some money to prepare using the tax software, because again, not all tax software is free depending on your income levels and your other circumstances, I am going to get some credit and get paid for this so I can keep putting up this videos for you. Thanks once again, and have a great day.